Welcome to Retire Happy, the show designed exclusively for the backbone of our nation, federal employees. Join your well-sought financial advisor, Mamadou Bojang, and his dynamic team as each week we delve into the stories, insights, and tips about your federal benefits and retirement. Buckle up as we embark on a journey to demystify your benefits and retirement so you can make smart and confident choices and retire happily ever after.
Welcome back to Tariffs and Your Nest Egg. Navigating retirement in a shifting economy. So I'm Alex. I'm your host today, and with us is our financial expert, Mamadou Bojang. In our previous episodes, we've discussed the basics of tariffs and their impact on individual investors. Today, we'll focus more on practical financial planning tips to navigate these uncertain times. And we're going to dive right into it and start with emergency funds.
Yeah, Alex, that's a good way to start. I mean, it's very, how would I put it? Sometimes it's very scary to have people come to the office and then not even having any emergency plan. They don't have any cash available, and you should not be doing retirement plan that way. It's like a ticking time bomb, right? Because we just don't know what would happen, right? And as you know, we deal with a lot of federal government employees. You go to the federal government to work there because number one, you have a service heart. You want to serve the country, right? But we also know that it's a place whereby at least you get that job security. Now, oftentimes I talk to clients about it. I said, well, if I talked to you 20 years ago and I said to you, hey, a federal government employee would be fearful of losing their job today, you probably tell me, Mama, to get out here. You don't know what you're talking about, right? Because if you want to serve this country and then you want a safety of your job, then you go to work at the federal government, right? But what have we seen now? It could be the federal government employees, you essentially you retire on your own terms, right? But that changed completely. So now we have seen people, because they felt like they're going to be going on their own terms, they've not done any of the planning. They don't have an emergency cash. No. So you do want to have an emergency cash. What does that mean? So typically what we will say is if you're a couple and you all have like a similar job, you're making similar amount of income, you need to have at least 3 months worth of your major expenses saved somewhere in the bank. Okay. Well, we realize that, okay, fine, you know what, you're not going to get that much in the bank and all that, but it serves a purpose. The purpose there is money that's readily available just in case something happens. It could be maybe the car breaks down or maybe a roof or whatever it is, right? Whatever the emergency is, you want to have that available. Now, if you're single, they would probably say you need 6 months worth of your major expense. And then if you're married, but maybe one spouse makes the most, right, then we probably want to say at least do 6 months, right? And then the reason here is sometimes it might take a long time when somebody loses their job for you to pick up another job. So hopefully in 6 months, you will be able to find something and to be able to replace your income now. But what you don't want to do is not having an emergency cash, and you have to go into your assets to be able to sell those, to be able to kind of like bridge the gap. You don't want to do that. That's why having that emergency cash is extremely, extremely important. And we've seen this all the time. People don't do that. It's a fundamental steps when it comes to retirement planning. Every sound financial advisor will tell you that you need to have an emergency savings, right? So having that in place is extremely, extremely important. And it could be somewhere. We're not saying that put it into like a checking account, but nowadays you could put it into a money market account, or you can probably even do it in a high yield savings account. That is where you get a little bit more interest rate, but you want to put it somewhere whereby you can get access to it. Well, I've seen people put that in a CD. Well, the problem with that is, unless it's a no penalty CD, but if you're going to put it in a 5-year CD, well, that's not an emergency. That's because that's not, if you want to touch that, you're going to have to pay a penalty on that. So you want to put that money, either a money market account or high yield savings account somewhere. That way, if you want to access it, it's not going to have like any repercussions in terms of like, penalty or maybe like you losing something, right? Yeah. But it is absolutely critical to have that in place. Yes.
That's wonderful feedback and great advice. So we hear a lot about diversify and diversification. That's a word that's thrown around a lot. And probably thrown around a lot incorrectly. What does diversify mean?
Yeah. Alex, a great question, right? I mean, but I always like to give analogies, right? So just think about your house. If you have all of your money, I know you don't do this, but if you have your money in your house, would you rather leave all of your cash in the kitchen? Or would you want to stash some upstairs in the bedroom, some somewhere? Most will probably diversify. So you put in your money in different places, right? So you don't put all your eggs in one basket. It could be very dangerous. So oftentimes I tell people, well, if you have all of your money in your right pocket, well, if something happens to the right pocket, then all of that money is exposed, right? So would it make sense to diversify and maybe put part of that money in your left pocket, maybe in the back pocket? Right? At least if somebody is going to rob you, well, maybe if they're able to get to the right one, maybe hopefully they will fill the left pocket or the back pocket. At least you'll be able to know, right? Yeah. But if you have everything into the right pocket, then that will be a problem. And that's what means in our investment world. You don't want to put all your eggs in one basket. So you can invest money in different ways. You can invest money in the size of companies. You can invest money in smaller companies, mid-sized companies, or you can also invest in large companies. As a matter of fact, you can even invest in overseas companies, right? But you can also invest in what we call industries. There are probably about maybe 11 sectors out there, or probably even more, right? But a sector would be, well, maybe you can invest in technology, medical, real estate, consumer, they're defensive stocks, right? So all these are industries that we have. And the reason why that is because the way the economy works, Alex, is in times like when there is a lot of volatility, well, you look at it and say, maybe one industry is actually going down. But if you have only 10% of your portfolio, only that 10% is basically what affected by that industry. But what if, as an example, if technology is going down, but you have only 10%, only 10% is affected. But maybe the medical industry, the healthcare industry is actually doing better. But if you have 20% of that in there, maybe, well, your 20% is actually affected by that in a positive way. So therefore, you balance, you look, your money spread across. That way, you diversify, you mitigate your risk, you spread it across. That way, if something happens, then you don't lose all of your money at the same time. Because if you buy one stock, let's say, as an example, and I'm not going to name a company out there, right? Because let's say you buy John Doe LLC company, whatever it is, whatever their company is. Well, you believe in that company, you feel like, okay, that's a great company. Maybe your friend actually convinced you that this is the new company that's going to come in. It's going to be like, next Facebook or whatever it is. And you take all of your money and invest it in there, 100%. Well, that's a huge risk that you're taking. Well, what if our goals and our dreams did not come true? And what if that company goes bankrupt? Then now what happened? You lose all of your money. But if you take a smaller portion of your money and then put it there and then the rest you put it somewhere else, if this company goes bankrupt, the only area is whatever that money that you put in that company will definitely go down. So that's why diversification is very, very, very important. Yeah.
It's really great feedback. And we also hear the term, long-term planning. And, what does that mean? Because I think people may have different views on what long-term means.
Yeah, Alex, outstanding question. Oftentimes you see this. We talk to folks, right? In addition, one of the things that we do mostly, like work with retirees and all that, people that are closer to retirement. But oftentimes we get younger folks that are coming.
We do.
They have a lot of years ahead of them, right? So, so you want to look at where you are at your stage and what you're trying to accomplish, right? So we're going to talk about the retirees first, people that are close to retirement, right? Well, Alex, you probably hear me say this before, right? So, people are living longer now because of advancing in medicine, technology, and all that, right? People are living longer, right? Now, retirement alone, people could live about 20, 25, even maybe 30 years in retirement, even longer. And then we do know that, you hear me say this all the time, right? There's three stages in retirement. There's the go-go stage, and then the slow-go stage, and then the no-go stage, right? Right? And I cannot tell you which of these stages are more important than the other, because they're all important, because you need what? Money. Yeah. Because the go-go stage is when you retired first, you have all this bucket list that you want to travel all over the world.
Oh, yes.
Well, it takes money. Well, at some point you've traveled, you've seen all of your destinations now. But maybe you want to have like a quieter time, maybe to actually go look for maybe go to like your favorite shows and all that, right? Yeah. Maybe you're going to pick up a golf game or whatever it is, right? That it takes money too. And in no-go stage is when maybe if you have not done the right planning, health issues comes into play. Because the reality is, Alex, as we get older, things break in our body, right? Yes. That happens, right? So all of those are very, very important, right? So long-term planning means you have to look at it from a time horizon point of view. Often I tell people it's not when you retire, because retirement is an event. But we have to look at more like when you retire, how long will your money last you? We look at that time horizon. So that's why making sure that you have that at the back of your mind, you plan accordingly. And these people come to the office and then they have all of their money in the target date funds, right? If you're just a regular investor, but then if you're in a TSP, you have the L funds, right?
Right.
And then most of the time, people look at those as, when you retire. Actually, no, it's supposed to be when you are actually going to need that money. So we've seen that mistake over and over and over again. And then, but we also look at the younger folks, Alex. We've seen people come, they're young, and then they have all of their money in somewhere safe. And then, my fundamental question to them is, well, you plan on living longer, correct? And most of the time they will say, yeah, well, when do you plan on retiring? And they'll probably say, oh, I'm not going to retire maybe for the next 20 years or whatever. But you have all of your money sitting in a G fund or maybe like in a somewhere safe. Well, you're in your 20s. Well, the question is, investments, we know that comes with risk. But over time, it gives you a return that a savings account is not going to be able to give you, right? And the other thing is, when do you want to take the risk? When you're in your 20s or when you're in your distinguished age? Yeah. When you're in the 70s, right? I'd rather take more risk when I'm 20 because knowing if something happens, you still have a lot of years ahead of you to be able to recoup. But if you get to your 70s and you want to, so if you're in the 20s, you stay safe and later on you get to a distinguished, you feel like, oh my God, I'm behind in retirement. Then now you're going to take more risk while the time horizon is very short. I think that would be a big mistake.
Right.
So oftentimes we've seen these people that are younger make these mistakes, and I get it. I mean, sometimes it takes like a financial advisor, somebody to kind of like break things down for them. That way they can understand, right? So I would hope that if there's somebody watching this, they will, and if you feel like what I'm saying over here kind of like resonate with you, reach out to us. Call us. We're more than happy to have a conversation with you. Hopefully, we'll be able to guide you on a path. That way you can enjoy your retirement and then be able to retire happily ever after. Because Alex, those are the fairy tales. We don't have that anymore, right? At the times whereby most people are desperate, at a time whereby we have unbelievable debt, and at a time whereby we're going to have over 69 million retirees at the same time. Going into retirement, I mean, if you have not done the right planning, the long-term planning, that could be scary. That could be scarier. So, because there's going to be more and more people collecting Social Security, and with the high debt, we don't know what that's going to look like. That intersection is going to look like, right? So having that planning in place, I think, is extremely important, especially when you're young. You have to look at like time horizons, long time. And if you're in a distinguished age, now it's the time for us to look at it and say, okay, do we want to take a little bit more risk off the table, or do you want to continue, right? So, and it could go other way around. I've seen people that actually came that we met with, who in their distinguished age, and they're taking 100% in the stock market. And a lot of times it's like, well, but the market is doing well. Well, that's when we get into the territory of what I call exuberance, right?
Yes.
Greed, right? And then, because as you know, the market doesn't tell you when it's going to go down, right? It doesn't give you kind of like doesn't come to you and say, hey, Alex, the market is going to go down, right? Take your money off, right? So we got to be careful sometimes at some point how you actually look at your portfolio and be able to put a plan in place. Yeah.
Well, that's great feedback and always really good insight. And we've covered a lot today. And I think a common question we get is, when's the best time to sit down with a financial advisor? Is it, when is the best time?
Yeah. Yesterday.
Right.
Yeah.
Right.
Yesterday was the best time, right?
Yeah.
But sure, we cannot get that back. So it's now. It's actually today. So Alex, and then we know this. I happen to believe as a finance advisor, because we've done a lot of retirement seminars to educate people, whether it's the federal retirement workshops or even maybe retirement seminars that we do to bring in folks to educate them about retirement, whether it will be tax planning, whether it will be portfolio, healthcare, estate planning. We've done all of that. So people do come and then we give them ideas. But what do? They don't act on it. So I happen to believe that, and when you talk to them, it's like, oh, I don't have the time, right? I'm busy and all that. Alex, the reality is such a default way of like not doing anything. Because I would guarantee if it's important to them, then you'll make time for it. If it's important, you'll make time. You'll find a way to actually go meet with a financial advisor. So one is like time. So I think most people that have a profound retirement, they act. They have an open mind to consider their options, but on top of that, they act to make a profound impact in their retirement, right? So if you're listening, time is not the issue. You have to be able to recognize that. The issue here is for you to actually act and then go meet with your financial advisor. And I think the mistake that most people also make, and I don't blame them, some people think of financial advisors, sometimes when you think about it, they're very intimidating. Oh, I don't have a lot of money. Oh, they're gonna judge me. Well, you come and see us. Well, because we're not intimidating, we don't judge you. We'll help you, right? But the best time to go sit with a financial advisor is probably when you're building your retirement plan. Because think of it, if you're building your house, do you want to build it on a very strong foundation or do you want to build on a shaky foundation? Right? Most people want to build on a strong foundation, right? Of course. So having a financial advisor while you're in the building process will be able to help you so that you can make a plan, a very strong plan, a very solid plan. That way you can build your retirement house on that. And that way, if things happen, then you'll feel pretty good, right? So I would probably say now is the best time, or yesterday, but now, right? You should not delay it. Hopefully, if you're watching this, you'll be able to pick up the phone or may call our office and schedule. That way we can meet and talk to you. Because I happen to believe that when we are able to get an opportunity to sit in front of them, you will find out that we are a powerful resource in terms of having a profound effect in your life, especially your financial life. Because time and time again, we get people give us that feedback, right? And Alex, you hear clients say that.
I do.
Come into us and say how they feel about how I treat them, right? I mean, you hear that all the time, right? So, yeah.
And well, I surely agree, Mamadou, and we do hear that on a daily basis. And we also hear, I wish I had done this 2 years ago, 5 years ago, 2 weeks ago. Yeah. That is a common refrain. Yeah. But that's what you provide.
Yeah.
That's what we provide.
And Alex, you know what? And I think that's an honest thing to say.
Yes.
But that's when we come in as a financial advisor. It's not my role to make you feel bad. Because when you tell me that, or when a client tells me that, or somebody tells me that, I recognize that they've realized they've seen the value now. They reflect in, wow, I feel I've done that. Well, we don't want to dwell on that. My job is to be able to uplift you now. Now let's focus on moving forward. We don't want to dwell on the back. I mean, like the past. We want to move forward. Because I want to make sure that I can excite you. I can put a plan in place to show you a way how you can still get to your destination. Right? That doesn't mean that, okay, if we get that time, it probably might be easier for all of us, but it doesn't mean that it's too late. We can put a plan in place and then be able to get there. It's almost like when you have when you encourage your friend to go to a gym, and then you're started, and then all of a sudden, January, February, they're all excited, and then when they start like quitting. Well, if they come back, they start February, March, they quit, and they come back maybe like June, they realize that, I should have continued. They come to you, would you want to dwell on that? No, you want to help them out. I'll be like, Alex, hey, I'm super excited you're back. Like, let's get this going, right? This is what we need to do, right? Okay? We put a plan in place. Let's get you to where you need to be. I'm gonna cheer you, right? I'm gonna make sure that I'm gonna be your advocate. I want to be able to excite you so that we can achieve this. Because at the end of the day, I know that if I can help you to achieve your goal, my God, that's something that I value a lot. And you hear me say this a lot. I'm a social worker by heart and a capitalist by brain.
Very good. Well, that's outstanding, Mamadou. And I thank you for sharing your insights. And to our listeners, if you have any questions on topics you'd like us to cover in the future, please feel free to reach out. And until next time, happy investing.
Until next time, stay informed, stay financially savvy, and keep shining as the backbone of our great nation. This has been Retire Happy, your benefits and your future. We've got you covered. Axiom Value Wealth Management LLC is a registered investment advisor. This platform is solely for informational purposes. Investing involves risk and possible loss of principal capital. Likes, endorse, and approve are not intended to be endorsements of our firm, our advisors, or our services. Please be aware that while we monitor comments left on this page, we do not endorse or necessarily share the same opinions expressed by site users. While we appreciate your comments and feedback, please be aware that any form of testimony from current or past clients about their experience with our firm is strictly forbidden under current securities laws. Please honor our request to limit your post to industry-related educational information and comments. Third-party rankings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation.